Stop talking like a hacker and start talking like a CFO. If you walk into a boardroom and start listing CVSS scores, you've already lost. You aren't explaining risk, you're showing off your vocabulary. Executives don't sleep better at night because you patched a buffer overflow. They sleep better when they know that their revenue stream is safe. Today, we're going to see how much effort it's going to take to fix this disconnect using a pretty simple tool, the Business Impact Analysis Maturity Assessment Checklist. Boy, that's a long name. But let's talk about a fictional firm called Precision Components. They make metal brackets for cars and planes, and they're growing fast. They had $8 million in revenue last year. But here's the catch. They added new CNC machines, they got ISO certified, and they started selling to aerospace clients. Their security team? They're still treating every alert the same way. They got a warning about an old server in the corner of the IT closet. They patch it or they ignore it based on a technical score. They might worry about it, but they've never really worked out what happens if this breaks? And if that old server controls their quality checks, a breach means bad parts ship out, which could mean lawsuits, which could mean losing the aerospace contract, and that could mean maybe the company goes under. Precision Components has got no idea that a low-severity vulnerability could cause that much trouble because nobody translated the tech risk into business terms. They're flying blind, hoping the plane stays up, and that's why you need this checklist. It challenges you to map your tech to the money, and the theory here comes straight from Chapter 3 of Cyber Risk is a Myth. The big idea is translation. Security speaks one language, business speaks another. Business impact analysis is like your tourist phrase book when you're visiting MBA land. It stops you from prioritizing based on how scary a bug looks and starts on prioritizing how much cash you lose if it gets hit. Now, there are other ways of translating security into business value, but this one here, this is about monetary losses. And most organizations, I think they've got a plan until they try to answer a simple question. How much does a 4-hour outage cost us? If you can't answer that, you don't have a risk strategy. You've got to hope. This checklist isn't just a form either. This is a mirror. It's going to show us where your process is broken. It's going to separate the we have a policy folks from we actually measure impact, the professionals. And if you want the deep dive on why this actually matters, check out Cyber Risk is a Myth, but honestly, you've got everything you need right here. So open the checklist. You see 5 foundations here. We've got foundation, governance, we've got methodologies and processes, we've got tools and resources, and then we've got stakeholder engagement. And we're going to partially run through this today with our fictional case study, Precision Components, just to show you how to fill it out. Don't just tick the boxes though. Be honest. All the boxes start empty. Your job is to decide which ones get a check mark based on what the company actually does. And when you do this with your company, I'd recommend getting consensus and talking to other folks, but first you need to understand how and why this thing works. So let's start with the Section 1 foundation elements. Let's look at the second box. We have documented our most critical business functions. Well, in our story, Precision Components is running on the shop foreman's memory. They haven't written anything down, so we're going to leave that one blank. Well, let's look at our fourth one. We've identified and documented our key regulatory and compliance obligations. Well, they are ISO 9001 certified. That means they definitely got those docs. All right, so let's go ahead and check that box. That one's actually a fact. They have to follow the rules to sell to aerospace clients. Now, let's look at the third box. We maintain an inventory of technology assets mapped to business functions. Well, they bought 6 new CNC machines last year. Did they update their list? Did they have a list? Probably not. Let's leave that one blank. So let's move to our second section of governance. Box 2 says executive leadership reviews and receives and reviews business-related security risks. Well, the CEO gets a weekly email full of green and red dots and deletes it unread. That's a fail. So we don't check it. So let's look at the 6th box here. The 6th box here is risk acceptance decisions consider business impact information. If they accepted a risk recently, did they actually look at the financial impact? Probably not, so skip that one. How about Section 3? Let's go down to our methodologies and our processes section. Our second box says our vulnerability management process includes business impact assessment. Well, like everybody else, they use a vulnerability scanner. They get a report. Does that report include business impact? No, it just lists bugs. So we're going to leave it unchecked. So let's look at box 4 instead. We consider multiple impact dimensions: financial, operational, regulatory, reputational. Well, maybe they've talked to that reputation in a meeting once. Let's give them the benefit of the doubt, and we're going to check that one. so that we can say they assume they know it matters even if they don't concisely measure it. But we need to be strict here. We need to assume that they only pass on things that they explicitly do. They've got ISO docs, that's one. They might have a basic incident response plan that mentions time limits too, right? So we could check that box in section 3 as well, for we include time dimensions in our impact assessment. And that's because ISO tends to require recovery times. So we'd go through all of this, and we're not going to belabor the point. I think you understand how this works. We'd calculate their score by counting the checks, and I didn't fill it in because you get the idea, and honestly, your numbers are going to vary based on your organization's relative maturity. So let's say that they hit 3 out of 6 in section 1, right? Maybe they've got a common vocabulary, maybe they've got ISO docs, maybe they got some risk tolerance. Let's say they got 2 out of 6. I don't know. Let's say they got 2 out of 6 in section 2, and let's say 3 out of 6 in section 3, right? Let's go ahead and just put those numbers in. So section 1, 3 out of 6, that's 50% complete. Section 2, 2 out of 6, that's 33% complete. Section 3, 3 out of 6, that's 50% complete. And then we do this for all 5 sections. And then, honestly, we're just going to total it all up. So, for instance, if you got 14 out of 30, let's just go ahead and throw in 14 out of 30, you would get, math on the fly, 45, 47%. Let's go with 47%. That sounds good, right? That puts our fictional company now in this defined phase, where it says that they have a documented methodology with moderate stakeholder engagement. That's a good start, but it's not good enough for modern threats that we all face as businesses. They probably need to be in the managed category or higher. But now we get to the real work, because that was just a gap analysis. Let's look at the bottom, the priority improvement areas. We want to pick the top 3 items that you didn't check. These are the gaps. Now, for our manufacturing friend, top 3 are going to be obvious. First, they need to figure out what a critical business function actually is. Then they need to make sure that they see understand their boss sees the risk in dollars, not in bits or red or green dots. And third, they need to figure out how much downtime costs. So we're going to capture each one of those on our lines here. Our first one is going to be that they have documented critical business functions and mapped technology assets. Our second one we're going to put in here, we're going to put in something for our executive friends. Executive leadership receives and reviews business-related translated security risks. And for our final line, we'll put in our third decision point here, which is that we're going to quantify the potential financial impacts of security incidents. Those 3 lines change things, don't they? They turn a guessing game into a plan. By checking the boxes they do have, and by leaving the rest open, we're starting to create a roadmap of what's missing. And you can then start to plan on how to close those gaps. But look at what we've built here, right? We've went from a company that's ignoring its risks to one it's the start of a roadmap. We didn't solve the underlying technical problems yet. And goodness knows there will be technical problems in each of these examples. But we've solved the management problem, process problem. You now know where the gap is between what security thinks is important and what the business actually cares about. So our fictional manufacturing company now knows they need to stop hiding behind technical jargon. It knows they have to teach the executives what a buffer overflow means in terms of lost contracts or lost revenue. We have a target. We've got a direction. And that's the result of this exercise. We get clarity, because if you can't translate your risk into a number the CEO and your CFO understands, you don't have a security program. Use this checklist to find those process holes and fill them with data. And please stop hiding behind acronyms and start protecting the business.